Hi everybody and welcome to a video which is going to be looking at business objectives. Okay, now we spend a lot of time together looking through how we calculate revenues and costs and using them curves to calculate profits. We're now going to be thinking about then what businesses actually want to achieve, and we're going to use those revenue and cost curves to be able to show different objectives that businesses might want to be following. Now, realistically, what you need to know for your exams are 4 different business objectives. We've got profit maximisation. In other words, the price and output point where firms will generate the highest level of profit possible. But then we've also got to be able to understand revenue maximisation, sales maximisation. Then we're going to be looking at something that we call profit satisfaction. Okay, now we're going to focus on the top 3 first of all. Now, we've drawn these top 2 in different diagrams before. Sales max is probably something a little bit more new. Now, you've got to remember that on a diagram, profit maximisation will occur when marginal revenue is equal to marginal costs. Okay, so remember that point. Profit max will occur when MR is equal to MC. Revenue maximisation will occur when MR is equal to 0. So if we go beyond that point, MR becomes negative, which means that additional sales would see revenue start to fall to the point where the firm maximises revenue, not profits. Sales maximisation is where the firm will produce the highest possible output point where they're making only normal profit. Now, hopefully you remember that normal profit will occur when average total revenue is equal to average total costs. So at that point now, the firm is making only normal profits. Profit satisfying we'll come back to in a few minutes or so. Now, what we can do, we can draw these 3 different objectives on a diagram. So we're measuring quantity against price, revenues and costs. So what we'll do, we'll first of all draw the revenue curves for a firm. Okay, so we've got here average total revenue, which if you remember is the demand curve, and it's also the selling price. We've then got the marginal revenue curve. Now what we'll then add are the cost curves. So we've got marginal costs, and then we'll add the ATC curve. Remember, ATC will reach the lowest point when it crosses marginal costs. So we've now got then the cost and revenue curves. Now what we'll do, we'll show these different output points using some different colours. So remember, profit maximisation will occur when MR is equal to MC. So on this diagram here, MR equals MC at that green blob there, and that will determine the output point. So we then go up to the demand curve to get the selling price. Okay, so you've got there the profit maximising output point for a firm. And hopefully what you can notice here as well is that this firm, the way I've constructed these curves, is generating super normal profit. Okay, so the ATR is above the ATC curve. That is profit maximising output. Now I use a different colour now then to show revenue maximisation. Now remember, revenue maximisation will occur when MR is equal to 0. So when you think about it, whenever marginal revenue is positive, additional sales would lead to total revenue increasing. But when MR becomes negative, then additional sales are seeing revenue actually fall. So revenue maximisation will occur at this point here, Q2. Now again, to determine the price, we go vertically up to the demand curve, and we get this point here. So P2, Q2 is where the firm will operate at when they're maximising revenue, not profit. Now, sales maximisation, again, we'll use a different colour for this one, will occur when ATR is equal to ATC. Okay, so on this diagram, this will occur at Q3. And price, again, will be determined by demand. And we get that. Let's look at that, everyone. On this diagram here, we can see profit maximisation, revenue maximisation, and sales maximisation. Now, what you'll notice is actually the firm will have more sales if they aim for revenue max or sales max than what they would do at profit maximisation. So when we looked at why some firms might want to become smaller, we could argue sometimes actually becoming smaller might actually see your profits increase. And this diagram here will back that up there. So profit max, revenue max, and sales maximisation. Now, we did say we'd look at profit satisficing. Now, profit satisficing is not as scientific as the other three. We're not going to say this will always occur at a particular point on a diagram. So we're not going to say it will occur, where profit max where MR equals MC, or revenue max occurs when MR equals 0. This could occur at various points on a diagram. Now, let me explain then what we mean by profit satisficing. So what we're doing here, the owners of the company or the managers of the company normally are trying to earn what they deem to be an acceptable level of profit. So they may not be maximising profit, but they're looking to generate profit levels which will keep what we call the stakeholders happy. Now, we'll think about what that means in more detail in a few minutes or so, but the main idea here is think about the principal agent problem. The managers are the ones that tend to control big organisations. The owners are the shareholders, and their share ownership becomes often quite diluted, that the owners might have conflicting objectives to the people that run the company. So the managers might work out what they think is an acceptable level of profit to keep the shareholders happy, but not push for profits to grow any more than that particular level. So, again, what we do, we draw the revenue curves, and then we add the cost curves. Okay, now just for reference, I'm going to add to this profit max and sales max. Remember, profit max will occur when MR equals MC, and that is where the firm would generate the highest level of profits. Sales maximisation would occur when ATR equals ATC. So we'll call that P3 because that's what we did in the previous diagram. Okay, now when you think about it then, P1, Q1 is where the firm generates the highest level of profits. If the firm was to go beyond P3, Q3, they would actually be making losses because the ATC would exceed the ATR. So ATC would be higher than ATR. So the idea would be that profit satisficing will occur anywhere between, and I'll use red for this, Q1 and Q3 on this diagram here. So remember, we don't want to be making losses. So profit satisficing, what we do, we might just find an output level where, okay, we are still making some supernormal profit, but we're not making as much profit as what we would do at P1, Q1. So we found an output level where we're not maximising profit, but we're keeping the shareholders happy. And of course, that could occur below P1 as well in theory, but try and think about it between profit max and sales maximisation is a simple way of thinking about it. Right, everyone. Now we're going to be thinking about then why businesses might want to follow these different objectives. So let's think first of all then about profit maximisation. Now, as a reminder, on a diagram, you will always show this where MR is equal to MC. Now, think about the most realistic reason why firms should aim for profit maximisation. Is this really the maximum reward for risk taking? When you create businesses, there's a big gamble. You've got to invest money into different factors of production, and there's no guarantee that people will buy the products that you've produced. So rationally, if you're going into the world of business, most entrepreneurs are doing it to generate the highest level of profit possible. You want the maximum reward for the risks that you are taking. So based on that, you would argue it's a really, really rational response. Why would you accept lower profits if you can earn more profits, is what we're saying ultimately. Now, on top of that as well, remember, many organisations are owned by shareholders. So a good level of profit would help influence the share price and the dividends. Think about it logically. If profits were falling, then your shareholders might sell. Well, that would bring down your share price. It would bring down the value of your company due to that drop in demand for your shares on stock exchanges. And that can make you more vulnerable to takeovers, other rival businesses buying your shares. So if you want to maintain a healthy share price, you want to be reporting good levels of profit. Now, on top of that as well, shareholders also expect dividends, which is their chunk of the annual profits from the company. The more profitable is, the more happy you can keep your shareholders by giving them acceptable dividends. Now, it's worth noting, though, that often firms will aim for what we call long-run profit maximisation. The idea is, in the short run, prices, costs, revenues, etc., will change massively. You know, there are so many different factors which will influence demand in the short run, influence costs of production. Now, you tend to find that firms will not respond to those short-run changes in costs. So, for example, if costs were to increase, firms may not in the short run raise prices, then lower them again when costs go back down. With the simple reason being, it's upsetting customers. It's taking away that stability and consistency. So you tend to find that most firms would aim for a long-run profit maximisation if they're looking at profit maximisation to be their main objective. Let's now think, though, about why profit max might not be the objective to go for. Now, the most obvious one would be this. We know that profit maximisation will occur when marginal revenue equals marginal costs. Now, if I go back to this first diagram, we can see this really clearly. If we can work out where MR equals MC, we'll charge P1 and we'll sell Q1 units of output. Well, realistically, firms are very, very complex organisations. Many firms sell lots and lots of different products in multiple locations across the world. They've got different costs that vary significantly. It's so difficult to work out on a diagram where MR equals MC. So if you can't work out where MR equals MC, can you realistically say that you're maximising profits? You might be aiming to maximise profits, but you cannot say for definite where profit maximisation will occur for your company. The next problem is the principal agent problem. And this is the idea that we've got this divorce of ownership and control between the people that run the company, the managers, and the owners, the shareholders. So the principal are the owners, the shareholders. The agents are the managers, the people that run the company. Now, you tend to find that when you recruit managers to run companies for you, they're often pursuing their own objectives. Remember, profits for the shareholders. It's not for the people that run the company. So the idea is that managers might be more focused on growing the company, expanding market share, increasing revenue, having more staff to control, their own salaries, their own fringe benefits, etc. So the idea would be that if the managers are not tuned in with the owners in terms of profits and they're thinking about different things, then the managers may not be pursuing profit maximisation. Another reason will be scrutiny. If firms announce really, really high profit levels, well, society can often be against it, thinking, well, hang on, if you're making such high profits, does that mean that you're ripping off your customers? Does that mean that you're not paying your staff or your suppliers sufficient money for the facts of production they're providing you with? Well, to keep away that scrutiny from society, then some firms might think, you know what, maybe we shouldn't be looking to make as much profit as possible. We've got to keep all those other people happy. So what you might do, for example, you might give your staff higher salaries than what you need to. You may pay suppliers higher money or higher cost than what you would need to in a free market economy. You may charge customers a lower price than what they should be based on profit maximisation. So you're not maximising profits, but you're keeping away that scrutiny from the public. On top of that as well, you've got to think about regulators. If a firm is making too much profit, the regulator may think, you know what, that firm is exploiting their power. They're charging customers too much money and they're not paying their suppliers or their staff, etc., enough wages. Well, if that's the case, the regulator might look to reduce their power, force demerger on the firm, fine them for it. So to keep away that scrutiny from regulators, you may accept profits below profit maximisation. Finally, we've got to remember that many organisations are also not owned by the private sector. Public sector organisations such as the NHS, for example, or schools and colleges, we don't exist to maximise profits. We're looking to follow other objectives. So the NHS, for example, is concerned about healthcare and about the well-being of society. Schools and colleges are more worried about the welfare of their students, helping those people find good jobs when they're older. So profit maximisation wouldn't be the objectives of those types of organisations. It's also worth remembering that charities as well are not for-profit organisations. They're trying to further causes instead. Okay, so not all organisations would be looking at profit maximisation to be their main objective. Now, the next one, revenue maximisation. Then, now if you look at the diagram, if you move away from profit max at Q1 to revenue max at Q2, then you've got a higher output level. So remember, revenue max will occur when MR is equal to 0. So let me give you a few different reasons why you might want to go for revenue maximisation. It could be linked to the principal agent problem again. The managers, the people that run the company, their bonuses or their performance for their annual appraisal might be judged against revenue targets as opposed to profit targets. It could be linked to the size of the company, and often revenue maximisation will mean that you've got more customers than what you would have under profit maximisation. So it's linked to that principal agent problem and how managers assess their own performance. Now, linked to that as well, many businesses that have got stock that need selling may aim for revenue maximisation. So think about businesses that sell perishable products, such as supermarkets, etc., florists, things that are going to go out of date. You may want to try and get some revenue that you can from them products before you get stuck with them and they're no longer sellable because they're past their sell-by date. So some revenue will be better than no revenue for them particular products. You tend to find that businesses that have got a lot of stock that is maybe time related. So, for example, technology. You may need to sell it by a particular date before new technology comes out. You may think, let's just go for revenue maximisation. Some revenue is better than no revenue for these products. Fashion businesses might do the same thing as well. You don't want to be stuck with last season's stock. So you may move towards revenue maximisation in order to sell off that surplus stock. So the idea is, everyone, that another reason linked to this then is to get about getting rid of surplus stock, things that you don't want to be stuck with. So revenue maximisation, get some revenue for it as opposed to no revenue for it. Right, the next one, sales maximisation. Now remember, this will occur on the diagram when ATR is equal to ATC. Okay, now think about why you might want to do that. Now, before we think about that, actually, let's think about the diagram. We're now operating at P3, Q3. So on this diagram here, we can see out of these three different objectives, sales maximisation is the one where we've got the biggest output level. It's the one that we're charging the lowest price for these products. Now, why might you want to do this? Well, there's a really, really obvious reason. It could be to expand. It could be a growth strategy to expand market share. You're charging lower prices, and because the demand is higher than what it would be normally. So if you're in a competitive market, you want to nick customers from rival businesses, you may move towards sales maximisation. Lowering prices, expanding sales, which means that your market share will grow, and it could be a really, really effective internal growth strategy. Now, other reasons then as well, it could be about keep society happy. If you're only making normal profit, the regulators aren't going to be on your back. It appears that you're not exploiting suppliers, you're not exploiting customers, you're not exploiting your staff. So it's going to keep them regulators happy. On top of that as well, though, it's going to keep your stakeholders happy. You're not reporting big profits which are going to annoy your customer base, your suppliers. You're keeping all those other people happy by declaring profits which are lower than what they would be under profit maximisation. Now, it could also be used, though, as a strategy to keep away competition. New firms coming into a marketplace, when they decide whether to move into a market, they'll look at the profits that the existing firms are making. If the firms in the market are making really, really high profits, they're thinking, well, hang on, we can move into that market and be successful. If the existing firms in the market are only earning normal profits, they're working at sales maximisation, it looks like a less attractive market to move into. So it keeps rival firms from potentially entering the marketplace. So that could be another reason for moving towards sales max as opposed to profit maximisation. Now, the last point, a really, really important one, is this one, cross-subsidisation. What some firms will do, they will have some products that they sell that are making profits. but then some of their other businesses or some products they sell will be making losses. So what some firms want to do, they want to keep the business big, they want to use it as a growth strategy. So profits from some parts of their business will be used to subsidize losses in other parts of their business. Okay, so for example, colleges will often do this. Some A-levels, for example, will have big class sizes. Some will have very low class sizes. So quite often, the big courses with big student numbers are making profits, but then that will be then used to subsidize losses in other courses across the college. And again, it helps keep market share high and give customers a good range of products. So try and remember that word, cross-subsidization. Now, last thing I want to tell you about is profit satisficing. Now, what we're trying to do here is to keep stakeholders happy. Now, a stakeholder is anyone that has got an interest in the performance of the business. This could be the shareholders. It could be the government. It could be the workers, the suppliers, and the local community. Now, there are more. You know, we could include rival businesses, etc., as well in this. But it's about trying to keep as many of these different stakeholders happy as possible. Now, when you think about it, if you're pursuing profit maximisation, the only stakeholder you're keeping happy are the shareholders. They're the ones that get them big dividends and the big benefit of the higher share price. But those big profits might, you know, alert concern from the government. Workers might think, well, hang on, you're making all these profits. Does that not mean you could be paying me more money? Suppliers are thinking, well, hang on, you're making all that profit on the products that we are supplying to you. Local community might be against them big profits as well for similar types of reasons. So the idea would be we're going to work out a profit that is acceptable. We've got to make sure we're giving these shareholders, you know, good returns, but it's about keeping all of these other shareholders, these other stakeholders happy as well. So finding a profit level which will keep not just the shareholders happy, but governments, workers, suppliers, local community, and other interested stakeholders as well. Okay, so the idea will be then, everyone, it's about keeping other key stakeholders happy. Now, linked to that, a bit more of a cynical reason for it, though, as well, is linked to the divorce of ownership and control, that principal agent problem again. Managers might simply believe that profit maximisation is too tough. It's a difficult objective to pursue. It's going to be really difficult, really, really time consuming. So he said what they might do is they might work out, you know, what is an acceptable level of profit for shareholders and work towards that instead. And that allows them to pursue their own objectives in the company, but it also will give them more leisure time as well. Now, everyone, just to bring all this together again, then, I'm just going to draw for you one final time in this video these different objectives. So you could almost practice this with me. So remember, we plot revenue curves, MR and ATR. We then add marginal costs and we add ATC. Okay, so we'll do profit maximisation in green again. Remember, MR equals MC is profit max. And that will be the price that we charge and the output we produce at profit max. If instead, though, we were looking towards revenue max, this will occur when MR equals 0. So here we will be charging P2 and producing Q2. And of course, if we were looking for sales maximisation, we find the highest output level we can produce at, lowest price we can charge before we start to make losses. So on this diagram here, it will occur at Q3. And of course, profit maximisation can occur anything below Q3 on this diagram. So anywhere where we're making, you know, acceptable level of profits, the business will work at. That could be somewhere between Q1 and Q2, somewhere between Q2 and Q3, etc. It could even be just before Q1. So anywhere where we're making acceptable levels of profit, we could add to that diagram there. Right, guys, well, that is the end of this video on business objectives. So thank you very much for watching.